Hello friends, welcome to Block Bytes. In the last video, I talked about the single most significant lesson I learned in 2022, the difference between CeFi and DeFi and the need for self-custody. But there was another important event that happened last year. It was the reason that led to the crash of CeFi. The event was the collapse of the Terra blockchain and its algorithmic stablecoin UST. But why am I revisiting this event now? For two major reasons. First, to drive home the point that DeFi too is vulnerable. And second, what retail investors can learn from this crash. Let's start by looking briefly at the Terra blockchain. The original Terra was a proof-of-stake chain created by Daniel Shin and Do Kwon. After the collapse of Terra last year, it was renamed to Terra Classic, and a new Terra chain was launched, but without the original stablecoin UST. In the original Terra chain, UST had a unique pegging mechanism. Instead of being backed by assets like other stablecoins or crypto, UST was mostly backed by its sister token, Luna. This is how it all worked. Luna and UST were intertwined with each other. Minting a UST was the same as burning $1 worth of Luna, and burning a UST was like minting $1 worth of Luna. This feedback loop kept the value of UST around the $1 mark, and it worked pretty nicely. There is one other important piece of information to understand. Stablecoins need some utility, like fiat, for people to hold on to them. Let's take the example of currencies. Why would you want to keep the dollar in a bank versus investing it in a stock market? The simple answer is interest rates. If the bank interest rates are better than what the stock market currently provides, you would put your dollar into a bank account. Similarly, UST needed an interest rate to incentivize buyers to buy more and hold on to it. Enter Anchor. Anchor was a saving scheme that paid UST holders a huge 20% annual interest. It was a big enough incentive for people to hold on to both Luna and UST in what would effectively be a perpetual bull market. The bull market was so strong that the demand for UST rose massively, and so did the price of its underlying reserve, Luna. On May 7th, hundreds of millions of UST were suddenly sold, which jolted it out of its $1 peg. The massive sell-off was considered an attack on Terra, and even the automatic mechanism to bring UST back to $1 could not cope with the pressure. People started to lose confidence in the chain and began to sell UST and Luna. And since the algorithm was designed to mint Luna when the price of UST dropped, it created millions of new Luna tokens, resulting in an even more significant drawdown in the price of Luna. Terra and its foundation tried to fight back by selling its reserves in BTC and Luna to buy more and more UST to curtail the fall, but that did not help. By the 11th, it was game over. Luna dropped to cents. A week later, the crypto market lost $1 trillion. Hindsight is 2020, but history repeats itself. Maybe not exactly. Still, it is incumbent on every single one of us to ensure that we are not caught in the next avalanche. There are several key things that I have learned from this event, but they all fall under one big umbrella. Do not be a blind investor. The key idea here is to spend time understanding a project so that you feel confident enough to invest in it or to watch it from the sidelines. The first thing you must do is to read about it on research websites like Messari and CoinMarketCap, or on other crypto news portals like CoinDesk and Decrypt, to name a few. Next, follow the project on social media, especially Twitter, and keep yourself up to date. Things change very quickly on crypto, and you should know when something terrible happens. As you spend time on Twitter, you will also find people with more than average information about a project. These could be part of the project or people outside of it. It is essential to not only keep an eye on what they say, but also on the comments received by them. Comments are crucial for a neutral and balanced perspective on any topic. Let's take Terra as an example here. If you never did the research, you would be oblivious to certain red flags. Like 1. Terra experienced a similar meltdown in January. It forced Terra Labs to step in and sell $1 billion of Luna. If this happened before, it could happen again. Second, the fact that UST was backed mostly by Luna and not a diversified set of other stable coins and crypto assets was yet another red flag. Anchor protocol providing 20% yield was probably the biggest red flag. If you think about it, Anchor had to pay 20% interest to their depositors every single year. The obvious question then arises, where do they get this money from? And is this sustainable? Remember, nothing is risk-free. And fourth, Do Kwon, the founder, had a history of failed stablecoin projects. This does not mean that UST was bound to fail, but it raises doubts about his and Terra's credibility. Surprisingly, or perhaps not, there is another project displaying similar red flags right now. TRON is a blockchain mostly known for its low transaction costs. In May last year, TRON launched its own algorithmic stablecoin, USDD, which it says is over-collateralized. Remember, stablecoins must be backed by an equal, if not more, amount of collateral. But this tweet here disapproves of that claim. According to their analysis, the collateralization ratio of USDD is 67% and not 200% as claimed by TRON. Another red flag is the massive 20 to 40% yield on depositing USDD in liquidity pools, similar to what we saw with Anchor. The third red flag is the depegging of USDD, which has yet to see it bounce back to $1. And finally, the fourth red flag is founder Justin Sun actively moving around the reserves from TRON to Binance. This may not be a sign of any impending disaster, but people are cautious. Twitter is full of tweets asking people to move out of TRX, the native token for TRON and USDD. If history is any guide whatsoever, then it makes sense to stay away from the chain until the situation becomes clearer. I want to end this video by shedding light on one crucial but overlooked aspect of DeFi and crypto. It was in 2014 that Ethereum's smart contract platform was launched, and it provided a means for creating cryptocurrencies. After seeing the massive price appreciation in Bitcoin the previous year, many of these coins were made hoping to capitalize on its bull run. But this did not last long. According to a recent report by CoinKickoff, 91% of all coins created in 2014 are now dead. This is similar to the dot-com era, where websites were mushrooming everywhere, only to fizzle and die eventually. The important lesson here is that only some coins are investable, More importantly, only a few projects are worth investing in. I hope you like this video. Relevant links are in the description. Consider liking and sharing, and I will see you next time with another fresh bite. Bye-bye.